Hey guys, welcome back to another video. I just want to say really quickly, thank you so much for the support. We're super close to 200 subscribers, and I'm just really excited because it's a new milestone for the channel. I'm a little slacking in terms of the channel art. It kind of cringe, not gonna lie. Gotta change this soon. But yeah, so as you can see, we're currently up 36% in about a month. Pretty nice. We're at 1.6 compared to last video. I'm pretty sure I was around 800. Our holdings are 200 Riot shares and almost 1.5 of Tesla. It's been doing pretty good. But yeah, so today's video is going to be a little bit different. I have a tablet, like an Apple tablet. Not trying to flex or anything, but I'm gonna see if I can integrate it to the videos and hopefully make it so you guys can understand certain concepts better. And yeah, so let me switch over real quick over there. Okay, so we're here on the tablet. So you can see that it says Investing for Dummies 101, basic course or whatever. So in today's video, I got inspired to make this video just because somebody approached me in one of my classes and asked if I actually invested and did sort of trading and stuff like that. Because I was looking at TradingView and just overall statistics of different companies such as Nvidia and AMD, because I'm planning to invest in them later on in the future. But yeah, so I made this little course kind of for dummies. Hopefully you guys enjoy it. Yeah, let's get started. So, Investing for Dummies 101. So, if you're new, you don't know anything about the stock market or anything at all, I first off recommend to download Robinhood, you know, right here, Robinhood. It's an app. You can probably find it in the App Store. Um, yeah, App Store. You can find it in an App Store or maybe Play Store too. 1 second, guys. I'm just writing this down. So it's pretty easy. It's the most basic app I recommend. Honestly, it's very easy to use, and I enjoy it. It's pretty much green, legit like Robinhood, like as the name suggests. So after you download Robinhood, you don't know anything. So that's step one. Download Robinhood. You're gonna need a social security number, which is pretty standard, and some sort of license to make sure you're over 18. If you're not over 18, you can get a parent account, or you can ask your parents to have an account and maybe you can administer it with your own money, some way or shape or form. But yeah, so after you get the account, you're gonna get a screen, basic screen, and then you're like, hey, what do I do now? I don't know how the stock market works or anything like that. So the stock market is a weird place. The stock market has nothing to do with the economy in the world at all. It has nothing to do with the world. So let's say there's a little ball right here is Earth, color it green. It has nothing to do with it. The stock market, it's its own separate entity or box or square, whatever you want to call it. The stock market operates in two ways. Um, Stocks go up, right? Let me write this down. They go up or they go down. How do they go up? People buy the stock. How do they go down? People sell the stock. This whole game of buying and selling is legit what moves the stock up or down. What can make it go up and get people to buy? News, new technology, good earnings. So that's legit the things that move the stock up, or speculation. That's the biggest one. Speculation. That is the biggest one of them all. What makes it sell? Makes the stock lower? Bad news, bankruptcy. Shit, I cannot spell, guys. I'm really sorry, but bankruptcy is a BK, not Burger King, but bankruptcy. Um, Layoffs, employees like Amazon, Google. Also speculation and rumors also. And yeah, there's a bunch of other factors as well. Okay, so I'm gonna move real quick. So we have the stock market. So what can we do in the stock market? So in the stock market, we can buy or sell action stocks. Sorry, man. And in Spanish, this is a different name. It's called activos, which means like actives, but just don't worry about it. So in the stock market, we can buy stocks. What are stocks, right? You may ask yourself. Stocks are a percentage of a company. So a company will go public and the spec, you know, and then when they go public, so let's do company XYZ for example. When they go public, they say, "Hey, we're gonna start off with 100,000 shares." So they're going public with these 100 shares, which are stock as well. Shares and stock are the same thing, right? 100 shares. So now you, as a normal entity, company, or just individual, can buy these percentage of a percentage of this company in the form of stocks. So you can buy 100 shares. Let's say 100 shares of this stock, and let's say each stock is $1. $1, right? So 100 shares, and then you bought them for $1 each. So $100, and you got 100 shares. So in total is $100 you spent. And then let's just say these shares go up and to value to 150. So you made a $50 profit. And yeah, that's pretty much it. Simple stuff. So it goes up or it goes down, doesn't matter. But that's what the stock does. The stock goes up, goes down. A company essentially is putting themselves in a public market where individuals and corporations or businesses in general can buy parts of their company in exchange for money. So the company gets money in return for stocks. Why do you want to invest in stocks in the first place? So stocks have many different classifications within it. It's a huge like subject by itself. I'm just going into the basics for people who don't understand how this works in this commodity market, or simply just make this video very simple for you guys. Okay, so stocks. Why do we want to buy stocks? So stocks can pay dividends. And then you may be asking, what's a dividend? Well, a dividend is a small percentage, right, of a company's earnings, and they can pay it back to the individuals who invested in the company. And then they're happy. Yay. Right? Companies are not forced to pay a dividends. That's just solely some of them have a dividends and some of them don't have a dividends. So these are called dividend stocks. And most of the time, these dividend stocks are mature companies. And you might be asking, what are mature companies? So mature companies are companies that have already been established and they already have their market. They make revenue. They are not planning to grow, and generally they just keep investors happy by paying them a small percentage of their earnings for that year. Then we have growth stocks, right? Growth stocks are similar to dividend stocks in the complete opposite sense. Growth stocks don't pay dividends. You are making money in this company by the simple fact that they're growing. So they're growing, expanding, and it's a more aggressive play. By aggressive, it means dividend stocks are like old people. No offense, but they take their time. You have to be gentle with them, and they don't do much. Growth stocks are like the excited teenager who wants to do crazy things, and risk to reward. So when in the markets, more risk equals more rewards. Less risk equals usually less rewards in terms of yield, in terms of percentage returns, and all that. So growing and expanding. Some examples of this you have heard would be Tesla, for example. Tesla, right? Tesla, Elon Musk. Tesla is a company that works on electric vehicles, right? This is a new market. They have slowly expanded. Yeah, they have expanded and the revenue keeps expanding, but they don't pay a dividend. So instead, what they do is they don't pay a dividend, but the stock is growing. So let's say $30 here, and then it goes to 100 because they announce a new vehicle, and then a new model 200, and they keep expanding due to the revenue, and so on. They keep going up because they're expanding their markets, and they have no limit. Until they reach a limit, they might not pay a dividends, and yeah, that's just the simplest way to explain it. Okay, next up, we have blue chips. Blue chips are usually companies that pay a dividend, but they're actually half of a growth stock. So how do I explain it? So they're like the middleman. If you're not too aggressive, but you want some growth in your portfolio, which I forgot to mention, a portfolio is like a pie. Just picture it as a pie. So let's say you invested $10 here, then you invested $50 here. It's just what you have invested. So your portfolio is a pie, and whatever you invested in, that's your portfolio. Everything inside this circle, everything you got your money divided to. So that's a portfolio. So I forgot to mention that. I'm sorry, guys. And then, okay, blue chips. As I was saying, blue chips are companies like Visa. You got the MasterCard, Visa. They got chips. Their stock is on the rise, kind of slowly and steady, and they pay a percentage dividends. So blue chips are stable stocks. Blue chips include, um, I believe, Google, Apple. Oh, my bad. It's APPL. Apple. So, what I'm doing right here, this is called a ticker. So a ticker is also called a ticker symbol, and a ticker symbol is legit the thing people use to find the stock. So each stock has a little code, usually in the stock market, and their ticker it's just an abbreviation of the stock. So in this case, for Apple, instead of writing the word Apple, it's APPL. Yeah, and then for Google, I believe is GOGG, and then for Tesla's TSL A, yeah, and so on. So ticker symbol is just an abbreviation of the stock, simple stuff. And yeah, okay, so back to blue chips. So blue chips are stable companies usually. They pay dividends. They're not as dinosaur-like as dividend stocks. So I didn't give an example for dividend stocks. So talking about dividend stocks, usually some stocks would be AT&T, Coca-Cola. So that's their ticker right here. And just other dinosaurs, 3M. Companies have been forever, and they pay dividends because they expanded to the maximum of their capacity. They cannot expand anymore unless they buy other companies. You know, compared to blue chips, um, that are stable, but they're still semi expanding, such as Disney as well. Disney is another company that they're expanding in revenue and stuff like that in different areas, such as streaming and their parks and merchandise. But they pay a dividends. It might not be as high as Coca-Cola or AT&T, but they pay something. And yeah, and then we get your degenerates. So then after that we have penny stocks. Yeah, penny stocks. And these particular type are legit your run-of-the-mill stocks. Penny stocks are stocks usually listed between $5 and less in value, and they're unpredictable, unreliable, and most of the time 100% speculation. So these include your pharmaceutical companies that you've never heard of, some random Chinese companies you've never heard of, and they're usually or in that made no profit whatsoever, or just nobody wants them. These are a big no-no unless you want to just simply risk a small percentage of your portfolio just in case you make a couple dollars in return. Because since they're only it's solely speculation, the stock chart looks something like that. You know, it just looks like that. It just spikes up, down, and so on. So I would stay away from these. Just don't do it. If you're starting off, just usually you should buy at least some dividend stocks, some blue chips, and maybe some growth stocks just to get yourself used to buying and selling. Um, but yeah, then you get your pharmaceutical stocks, and that's pretty much in the same category as penny stocks. Simply, their growth depends on news about drugs and FDA approvals, and that's a later subject. I don't want to get into that right now. So far, you should be able to know the basics. So, investing for dummies 101, stock market. It's not related to the economy whatsoever. We already discussed that, right? So it's its own separate market. You're selling commodities and buying commodities. You can buy a stock, it goes up or it can go down depending on buyers and sellers. So the different pressures, right? It goes up by news, new technologies. It goes down by bad news, layoffs, and speculation as well, or bankruptcy. That's a big one, especially when their company goes bankrupt. We discuss different types of stocks, such as dividend stocks, growth stocks, blue chips, and penny stocks. Okay, so I hope you guys understand all those basic terms and so on. So let's get into some terminology. So let's go into terminology. I'm sorry if my spelling is not the best. I'm just not very good at spelling. I do apologize, but hopefully you can understand just simply by my voice or whatever. Okay, terminology. So there's three types of markets. Right now, there's something called the bull market. Well, it's not right now, but back during the pandemic when they were giving out stimulus checks and everything was through the roof in terms of stocks. You heard Bitcoin was at 60,000 and everything was great. It's called a bull market. When someone quotes bull market or says bull market, it means that the stock market is up right now. It's a ascending trend and it's upwards. When someone describes a bear market, they're usually referring to the fact that, bears are bad. Bear means the market's red, bleeding. Red means go down and then green goes up. It just basic colors, it makes everything simpler. Some people take the colors away, but that's pretty much it. And then there's a weird guy. This guy can be classified into two, either a kangaroo or crab market. It's just choppy. So like it's not determined. You know what I mean? It's not up or down. It's usually in the middle. Um, Most of the time we get small periods of choppy market, but it's usually between these two guys right here, bear and bull. I'm pretty sure the reason why they named it is because like bears are looking down with this, snot, and then usually bulls are up, I guess. I don't know. But that's pretty much the terms for the markets. Okay, let's get into another detail. Earnings. So, public companies need to report earnings. What are earnings? So, each company that's listed publicly will have to report earnings, and then earnings are 4 quarters. So, what are quarters? So, every 3 months, a company has to report earnings, and you'll probably see a chart like this. 1 second right here. You'll probably see a chart like this. It would have a green bubble here, green bubble here, and then these earnings will be labeled as Q1, Q2, Q3, Q4, and then go back to Q1. So there's three. So there's 12 months in a year, obviously. And then every 3 months, a company has to do this, have to display how much they've made or lost during the years. This is a very important time. Companies, when they post this information, is usually before markets, during markets, or after. And this can impact your stock greatly. If it's good earnings, so if it says surpassed earnings, that means Okay, so let me backtrack real quick. So companies usually expect a certain amount. So let's say expect 30 cents per share. They usually expect 30 cents per share. But if their actual earnings is 40 cents per share, that means that their expectations is above, or it broke expectations, or above, you know. So this motivates investors to buy into the company due to the fact that they were expecting a lower number, but instead got a higher number in terms of um, cents per share or dollars per share increase for the quarter. Um, you can look at this statistics annually, which is a long picture type of thing, and so on. But yeah, so that's earnings. It's very basic concept for you guys, so you guys can understand certain things. Um, so let me explain how the markets open and close. Okay, so stock market. So your portfolio probably looks something like this when you start off. Actually, no. When you start off, it looks like this, just a straight line because you have $0. But then after you start investing, your portfolio will look something something like this. It goes up, down, up, down. So don't focus too much on the direction of your portfolio overall. You know, many people will implement strategies and look at charts and stuff like that. If you're really trying to make a difference, you should be looking at financial information. Look at what's gonna change the world in a couple of years, and just invest based off that information. No pattern, no nothing. You know, just old school. Just the stock, you, and their information, spreadsheets, and statements. You know, don't go Warren Buffett on us, but yeah. So your portfolio will look something like this, and then you'll have a period in time which is called the pre-market. So each time zone has a different time in which the stock market opens. So we have this period called the pre-market. And don't get too scared because the pre-market is a unpredictable thing. The pre-market usually determines the way the day goes. Sometimes it can be red and it goes green. Sometimes it can be green and can descend into chaos. But the pre-market essentially is a period in time which banks, institutions can trade stocks, but individuals like you and me can't. You can set a queue, but you really can't buy into it because this period is like a it's like a before. It's like getting ready for the real market, which is that. So that's pre-market. Then market opens, and then you can start trading. Like for example, for me, my day starts at 10:30. In terms of my market opens at 10:30. Before 10:30, all that is pre-market. So if I wake up at 4:50 in the morning, I have to wait till 10:30 to actually buy stocks or sell them. So yeah, that's kind of sad. So if you leave close to New York, I believe your time changes to an earlier time. So yeah. So then after market's over, you get aftermarket, which most of the time earnings happens aftermarket. And then aftermarket is the same thing. It's just the market's closed and then institutions are buying or selling or trading their things. So their stocks. But yeah, it's crazy. These two time periods can differ a lot, but most of the time the middle is what matters the most. You want to have a consistency in your portfolio. And then another term you can use is called diversification. Specific, bro, I don't know, just D for sure, bro, because I can't spell for crap. So D, D, not for D's nuts, but D for diversification. So what do I mean by this? Again, we mentioned in the pie chart for your portfolio. Previously, you should diversify. This means don't put all your eggs in one basket. You probably heard that before. So you want to have a nice pie chart with different stocks in here. This way, in the future, if one of them goes red and you have a couple more that are green, your portfolio overall will be up compared to if you had everything the same stock, everything will be red and then it would go down. So if you have more options, the probability of you beating the market or simply just making positive returns is higher. So that's diversification. So we mentioned the stock market, we mentioned earnings, up, down, then shares and all that. And yeah, that's pretty basic stuff, guys. What else do we have to discuss? Let me see what we can discuss here. Yeah, let's see. Then you have volume. You might ask, what's volume? Volume is the amount of shares traded for that day. So volume is the amount of shares sold or exchange hands to that day. Volume is usually on a daily basis. Bigger companies, when you look at them like Apple, for example, will probably have something crazy like 35 million, like in a day, or even 65 million. It's just a big number because it's a publicly known company. So the bigger the company, the more volume it has. What this means is with more volume, more stock movement. This means the stock moves up or down more drastically or more precise compared to a company that has less shares traded daily. Let's see what else. Then 52-week high, it just means the yearly high of that company. So if the yearly high is $72, this is the highest the company has ever gone in a 1 year period. So that's some information. Then you have the 52-week low, which is the same thing. It's just the lowest point the company has gone, so $5 in the past year. And yeah, it's just pretty basic. So that's volume. Let's see what other terminology we got. Oh, I forgot to mention. Okay. So we have stocks and then we also have ETFs. So you might be wondering, what the heck's an ETF? An ETF is legit, just imagine a branch. Imagine a branch with more little branches, and those little branches expanded to more branches. And these branches make up a stock or an ETF. It's called an ETF, but it works the same way as a stock. So all these little balls I'm drawing, yeah, it's a company. All these little balls are companies. So all these little balls are publicly traded companies, and when you click on the ETF, it'll give you specifics. But all these green dots are companies, right? And all these companies are in one ETF. So there's an ETF called SPY. So it's the S&P 500. You probably heard of it. If you haven't, well, now you do. So SPY 500 has a top 500 companies in the United States, which includes Apple, Google, Amazon, Tesla, Microsoft, and so on. Johnson and Johnson, and yeah, so all those companies are in this little stock called an ETF or S&P 500. That's the name it goes by. So what this means is if a company goes bankrupt, the company loses value. It'll get let's say number 500. So number 500 would essentially leave. So let's say 500, the company that's labeled as 500 goes bankrupt. Number 501 would take its place, and if one goes under, the other company that goes up next would take its place. So this is a great strategy in the long term because usually the market goes up. The market has some periods of downtrend, but usually it's positive and it goes up in the long term. And ETFs are a safe way to diversify your portfolio because you, with $100 invested, you're not just investing in one stock. You're investing in all of these together. Even if it's a fractional share, which is a small percentage of one stock, you're still playing the game, or you're still taking place. You're participating in the market with big name corporations. So that's an ETF. But yeah, so just diversify your portfolio. Make sure you read some information before you make a decision. Um, yeah, deposits. Then you have instant deposit, which is not, that's just for the app itself, but you get the point. So that's pretty much the stock market. It's a complicated place. Just make sure you read and look at other YouTubers for information. Hopefully, you get educated before taking any decisions. Remember, I'm not a financial advisor by any means. Just trying to help out, and make a difference, and hopefully get to 200 subs. Um, but yeah, I don't know what else I get to do today. Let's see, what else can we talk about? Huh. Yeah, so we talked about stocks, we talked about blue chips, dividends, all that. So for example, right now in Tesla, Tesla had 180 million shares traded today, just today. That's pretty intense. And then I'm looking, you can see shares, portfolio diversity, employees. There's not a lot of things to discuss here. We discussed earnings. Yeah, I'm pretty sure that's it. Again, this is not a get quick rich type of deal. Investing in the long term outweighs any day trading, any specul. The whole market is speculative, but it just, if you do it long term, it's better. Just trust, honestly. Like, many people have done it and they've shown results, and most of these people are just trying to sell you a course on YouTube, trying to buy their course to make millions of dollars off a computer and a laptop, which is true, you could, but if you invest in the long term, you're actually going to keep your money instead of blowing it in one day, buying some ridiculous stock from China or something like that. So yeah, so stay safe out there, guys. Hope you enjoyed this video. I know it's a little long and kind of weird in terms of like perspective, but hope this video could help you somehow. And yeah, this is not a secret to success. Anything's just building habits, and then that's what will get you to taste success and experience success. By any means, I'm not successful at all. I'm just making this content, and hopefully, you guys can be with me in my journey of learning and evaluating. But yeah, hopefully next video I can make another video with my tablet if you guys enjoyed it. And yeah, appreciate it. See you in the next one, and I hope you guys have a good one. Peace, and I'll see you.